What's going on, you guys? My name is Zach Hartley, and in this video I'm going to be talking about selling the premium, or taking the other side of that trade that we've talked about so far. So real quick, I just want to do a quick summary to cover what we've gone over so far, just so we can establish a baseline for this lesson, because it's a little bit more complicated. So you can buy a call option, and that would mean you're bullish on the stock. You can also buy a put option, and that would mean you're bearish on the stock. And when you're doing that, you're paying a premium for the option to buy or sell at a strike price on or before the expiration. So those are the basic two trades that we've talked about all the way throughout this course. But what we need to hit on and what we need to talk about real quick is the other side of that trade. Anytime you go into the market and you buy a call option or you buy a put option and you pay a premium, there is somebody on the other side of that trade that is selling you that premium and is going to back up that option. So what we are going to talk about in this video is how to get on that side of the trade and what it actually looks like. Okay, so selling the premium. This is the idea of taking the other side of the trade and making time work for you. As time goes on, your premium is actually going to appreciate in value as opposed to depreciate in value, like when you buy out of the money call and put options. The idea here is that you are going to collect the premium up front, and if that option expires worthless, you will be able to keep the entire amount of that premium. Therefore, your maximum return whenever you sell a premium is 100%. You're never going to make 200, 300, 400% on your premiums. You're only ever going to make 100% on your premium. However, some of them have unlimited loss and unlimited risk because it's the exact same trade as shorting a stock. If you short a stock and the stock goes skyrocketing up, you have unlimited risk. It's the same thing here with the options and selling the premiums. So we're going to talk about that real quick. Now, before we get into that though, every time you place an options order, there's going to be 4 different types of orders that you can place. Those types of orders are made up of buy and sell and open or close. You can do any 4 of those combinations. So I'm going to walk through all 4 of them real quickly for us right now. So a buy to open, this is a really simple order. This is what we've talked about mostly in this course. This is when you buy a call option or you buy a put option and you pay a premium for that option. To get out of that trade, you sell to close. You sell a call option or you sell a put option and you basically recollect that premium, or the other option would be to execute that trade later on. Now, on the other side of this, you have the sell to open. This is the idea of selling a call option premium or selling a put option premium. So when you want to sell the premium and you're going into your trades, you would click on sell to open. What that's going to do is it's going to basically let the bank let you borrow those options. You're going to go out and to sell them into the market, and if they expire worthless, you get to keep all of that money. If they expire in the money, you then have to be able to cover that option. That's the idea here, but in order to receive that premium, you have to place an order type that is sell to open. To get out of that trade, you then buy to close. The idea here is that you have a sell to open trade and you basically have a couple of options that you have liabilities for. In order to close that out, you buy the options on the other side of it. They basically cross each other out and you get to keep the difference. Hopefully it's some profit. Sometimes you might have to cover the loss. But the idea here is to buy to close is buying the call option premium, buying a put option premium, and Xing out that trade and getting out of it. You pay the premium to cover your position and hopefully you can keep the difference as some profit. Now, selling a call, this is the example that we're going to go through, and we're going to use Ford Motor Company. And the idea here is that we're going to sell a call premium. So there's a real strike price and a real quote that I just pulled from my bank. It is Ford at an $8 strike price with an expiration of September 18th. The underlying price of Ford stock right now is $6.61. And the last price that this executed at was 9 cents. So that's what we're going to use for our math here. So if we were going to sell the call option at an $8 strike and an expiry on September 18th, the last price for it was 9 cents, and it comes in a contract of 100 units, meaning that we would collect $9 per contract for this trade. So if we execute 1, 2, 3 trades, it would multiply it by 9, and then you have to add a commission depending on the platform you're on. In this instance, we are selling that premium for 9 cents at a strike price of $8. So that means that somebody else is buying that long call at a strike price of $8 and paying 9 cents on it. It means their break even is $8.09, and so is ours. So if the stock stays below $8.09, we are going to make money on it because that premium, that option, is going to expire completely worthless. If it goes above $8.09, that person may want to execute on that option when the expiration date comes. In that instance, we have to be able to cover that difference on that stock when it expires. Now, here's where the unlimited risk comes in, is if that stock goes from $8 to $20, that's a $12 difference that we would have to cover on every single stock, meaning 100 units or like 120, what is that? $12 times 100, $1,200. $1,200 coverage on like a 9-cent trade. So really important to know these numbers and understand these math, because when you sell a call option like this, you have unlimited risk, and this is considered naked. In the next video, I'm going to talk about this. We're actually going to make this trade, and we're going to hedge our risk by buying a call option at a higher strike price, and I'm going to walk you through that entire trade in the next video. But in this instance, we would have a break-even point of $8.09. If the stock does not move above $8.09 before September 18th, that option will expire worthless, and we will get to keep 100% of our initial investment. If before then it is in the money and the stock price is above $8.09, we will be out of the money and we will have to cover that difference. This is what the chart looks like. So this is how you read the options charts. So we have price on the bottom, $7, $8, and then $9 over here. And then we have your return in number in actual dollar amount. So our maximum return on this on a per share basis is 9 cents. So anything below $8.06 here is 100% return for us. This is where we're going to make our money. So anything below this kind of just above $8 mark, $8.09 mark, is going to be pure profit. We're going to keep our entire initial investment. If the price goes above $8, you can see that this line here then turns to red. And you can see that we lose almost 20 cents for every 50 cents that the stock goes up. So as you can see, if the stock goes up $10, $15, $20, we're going to lose a drastic amount of money on this premium because we have unlimited risk. Now, the other side of this trade is selling a put. So this is the exact same idea as what we just talked about, but selling a put. So Ford, $8 strike price, September 18th expiry. The last price for this put was $1.50. So if we sell the put for $1.50 times 100 units, we will collect $150 per contract in income. Now it is an $8 strike price. It is $1.50 to get into it, and it is a put. That means that $8 minus $1.50 gives us $6.50. Therefore, the person on the other side of this has the ability and will be in the money at $6.50, and we will be in the money if the stock stays above $6.50. With this, we can also only gain 100% of our initial investment. If that premium expires out of the money, we are only ever going to make $1.50 no matter what price it's at, because it is going to expire worthless, and we will just get to keep our initial investment. So here's what the chart looks like for this one. So when we sell a put, it means that we want the stock to remain higher than a specific level. The strike price was at $8, and we sold that put for $1.50, meaning our break even is $6.50. That's what this blue line here represents. So if the price goes below $6.50, you can see the red line continues, and we lose all the way down to $1 at $5.50 and probably $1.50 at $4.50. However, if the price continues to stay above $6.50, $7, $8 here, we will always maximize our return and cap out at $1.50 return and keep 100% of our initial investment that we captured as a premium. So this is a really good way of looking at it. These charts do a really good job of understanding your position, so make sure you can understand them and read them. Now, a couple of things that I just want to cover before we move on to the real life example in the next video is selling the premium. You sell to open, whether it's a buy, whether it's a put or a call, and you buy to close, and that's what's going to cover your position on that premium. When you sell the premium, time works in your favor. So you want time to go by as quickly as possible, because that means that you are closer to expiry and you will be able to keep 100% of that premium. When you sell a naked call, it has unlimited risk. So what I recommend is, if that is your strategy, you should buy an out of the money call as well, so that if that stock skyrockets, you will make money on that call. And that is exactly what we're going to do in the next video. The last thing is you get 100% return if the option expires out of the money. You are not going to make 500, 1,000, 2,000% return because you got really lucky on this one. Your gains are capped at 100%. So you need to use this strategy wisely, and a lot of the times investors will use selling the premiums to couple it with other trading strategies. We're going to go through that a little bit later on in this course, but in the next video, we are going to sell a call and we are going to hedge our bet and de-risk that bet. So stay tuned and we'll talk to you soon.